Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the Acca tutor, Jerry Mutumkulu. I'm here to take you through our first week lecture in the strategic business reporting, which is one of the Acca's essentials at professional level. So an essential module at the professional stage. Okay, so we're going to deliberate on what is expected by the examiners in this high-level paper, okay, which is focused on financial reporting. Okay, so without wasting much of your time, let us go straight to the business of the day. All right, what you can see there are just my credentials. Okay, you can get in touch with me there. This is just a flyer. All right, and we offer Acca qualification all modules. We also do mentoring for those who have opted for the Acca Oxford Brooks Bachelor of Science degree in Applied Accounting. I'm a registered mentor as well as a business consultant. So I can help you in most aspects of your business if you need some assistance where I can. All right, the objectives of this lesson, by the end of this introductory lesson, students should be able to understand the underpinnings of the advanced level accounting discipline in terms of standardization and regulation under the two following facets. All right, we are going to discuss the financial reporting framework, the regulatory framework, and be able to discuss and prepare consolidated accounts of basic groups. So as you can see, we've got a lot of things to cover, but these are just basics and you need to know them as you proceed with your studies in this Acca paper. All right, the strategic business reporting paper. The SBR exam, formerly called the corporate reporting or P2 exam, requires you to demonstrate your ability to make strategic business reporting decision. So remember, this is financial reporting at strategic level, okay, which means at the apex of a company or business entity. It is set within the corporate reporting environment, which means you will be tested on concepts, theories, principles, and crucially, your ability to apply this knowledge to real-life scenarios. The exam, like those of other strategic professional papers, is of 3 hours and 15 minutes, all contain 2 sections, and all questions are compulsory. All right. When the examiners are saying compulsory, all sections are compulsory, it means that you just have to show, more effort in both the sections. You shouldn't just focus on one section and concentrate most of your energy in that section and neglect the other. If you do that, you are likely going to fail. All right. The exam contains 4 professional marks, which you can earn if you show some professional maturity in the way you answer the questions. From March 2020, all strategic professional papers will be available by computer-based examination. More detail regarding what is available in your market will be on the Acca Global website. Please visit this website regularly, if not daily. The Acca pass mark in every exam is 50%. Okay, you can also read through that part on your handout. Okay, as well this one, we need not to concentrate much on those, but I want you, for those who are intending to write exams this coming September, this is actually the main focus, the main syllabus areas we are going to tackle. All right. On successful completion of this paper, candidates should be able to apply fundamental ethical and professional principles to ethical dilemmas and discuss the consequences of unethical behavior. So you can see that the issue of ethics is actually of paramount importance when you want to pass every Acca paper. You need to evaluate the appropriateness of the financial reporting framework and critically discuss changes in accounting regulation. Apply professional judgment in the reporting of financial performance of a range of entities. Note that learning outcomes in Section C of the syllabus can apply to single entities, groups, public sector entities, and not-for-profit entities where appropriate. Prepare the financial statements of group entities. Interpret financial statements of different stakeholders. Remember, when we are talking of financial statements, we are mainly referring to all financial statements in terms of IS 1, which talks of the statement of financial position, statement of comprehensive income, right? Statement of changes in equity, statement of cash flows, as well as the notes to financial statements. All these will be asked in this exam. You need to know everything, whether for a single entity or for the group of companies. Communicate the impact of changes and potential changes in accounting regulation on financial reporting, and then demonstrate employability and technology skills. All right, so these are our area of focus, ladies and gentlemen, as we are heading toward the September exam 2022. Okay, you can also start that diagram there. Now let's talk of financial reporting framework. Here we deal with two issues: the concept of profit or loss and other comprehensive income, and then the conceptual framework. These are the two financial reporting framework we'll be discussing. All right. Now the concept of profit or loss and other comprehensive income. It is generally known that the performance of a business in any particular accounting period is reported in the statement of profit or loss and other comprehensive income. International Accounting Standard Number 1, presentation of financial statement, defines profit or loss as the total of income less expenses, excluding the components of other comprehensive income. Other comprehensive income is defined as comprising items of income and expenses, including reclassification adjustments that are not recognized in profit or loss as required or permitted by other international financial reporting standards. Total comprehensive income is defined as the change in equity during a period resulting from transactions and other events other than those changes resulting from transactions within owners in their capacity as owners. However, there's been an ongoing debate in recent times as to where and when profits or losses should be included in the statement of profit or loss and other comprehensive income. It is incorrect to state that only realized gains are included in the statement of profit or loss, and that only unrealized gains and losses are included in the other comprehensive income section of the statement of comprehensive income. For example, gains on the revaluation of land and buildings accounted for in accordance with International Accounting Standard Number 16, property, plant and equipment, are recognized in other comprehensive income and accumulate in equity in other components of equity, which is a reserve. On the other hand, gains on the revaluation of land and buildings accounted for in accordance with IS 40 are recognized in statement of profit or loss and are part of the retained earnings. Both such gains are unrealized. The same point should be made with regard to the gains and losses on the financial asset of equity investment. If such financial assets are designated in accordance with IFRS 9 financial instruments at inception as fair value through other comprehensive income, then the gains and losses are recognized in OCI and accumulated in other components of equity. Whereas if management decides not to make this selection, then the investment will will by default be designated and accounted for as fair value through profit or loss, and the gains and losses are recognized in statement of profit or loss and become part of retained earnings. So what then shall we say? All right. There is at present no overarching accounting theory that justifies or explains in which part of the statement of gains and losses should be reported. So rather than have a clear principles-based approach, what we currently have is a rules-based approach to this issue. It is down to the individual accounting standards to direct when gains and losses are to be reported in other comprehensive income. This is clearly an unsatisfactory approach. It is confusing for for users. In March 2018, the International Accounting Standard Board, the ISB, published its conceptual framework for financial reporting. This addressed the issue of where to recognize gains and losses. It suggests that the statement of profit or loss should provide the primary source of information about the entity's financial performance for the reporting period. Accordingly, the statement of profit or loss should recognize all income and expense. However, the board may also provide exceptional circumstances where income or expenses arising from the change in the carrying amount of an asset or liability should be included in other comprehensive income. This will usually occur to allow the statement of profit or loss to provide more relevant information or provide a more faithful representation of an entity's performance. While this may be an improvement on the absence of general principles, it may be argued that it does not provide the clarity and certainty users crave. This leads us to a new area on recycling of gains or losses from equity to the statement of profit or loss. Now, let's talk of the recycling or reclassification from equity to profit and loss. Recycling is the process where gains or losses are reclassified from equity to statement of profit or loss as an accounting adjustment. In other words, gains or losses are first recognized in the other comprehensive income and then in a later accounting period also recognized in the statement of profit or loss. In this way, the gain or loss is reported in the total comprehensive income of two accounting periods and in colloquial terms is said to be recycled, as it is recognized twice. At present, it is down to individual accounting standards to direct when gains or losses, and losses are to be reclassified from equity to statement of profit or loss as a risk classification adjustment. So, rather than have a clear principles-based approach on recycling, what we currently have is a rules-based approach to this issue, as already been highlighted. So, for example, International Accounting Standard number 21, the effects of changes in foreign exchange rates, IS 21, is one example of a standard that requires gains and losses to be reclassified from equity to statement of profit or loss as a reclassification adjustment. When a group has an overseas subsidiary, a group exchange difference will arise on the retranslation of the subsidiary's goodwill and net assets. In accordance with IS 21, such exchange differences are recognized in other comprehensive income and so accumulate in other components of equity. On the disposal of the subsidiary, International Accounting Standard number 21 requires that the net cumulative balance of group exchange differences be reclassified from equity to P&L as a reclassification adjustment. That is, the balance of the group exchange difference in other components of equity is transferred to statement of profit or loss to form part of the profit or disposal. Please refer to the SBR technical article on the Acca Global website. So you just have to go to the technical article section on the Acca Global.com for further details in this one. Now, what are the different approaches to reclassification? There are three different approaches to reclassification. Ignore all possible reclassifications. Permit only a few reclassifications, that is the narrow approach, or permit or reclassification if they provide useful information, which is a broad approach. Okay, ladies and gentlemen, you can go through this part. All right, you can just go through this part, as you just have to, understand much of this, as they are just discursive elements. Okay, they are just discursive elements. One thing I just want to highlight with discursive elements, the idea is not to regurgitate the material, all right, but it is an issue of application at this level. All right, you may be given a scenario in the question, in the exam, where you are being given issues which needs some discussion. Okay, these are the, your reserves, where you can get all the points needed to attack an exam question. All right. However, the purpose of this video is actually to take you through where there is need for some workings. All right, where you need some computation, some assistance with regards to computation. All right. So the idea of reading, this is why we give you the note so that you read through. All right. So please allow me to just skip this part. All right. All right. The Isb Conceptual Framework. We've already highlighted that the conceptual framework was revisited in March 2018, okay, where it was revised. All right, the latest revision was in March 2018 to the conceptual framework, and in this framework, the Isb was highlighting certain changes. All right, the primary purpose of financial information, according to the revised version of the conceptual framework, was that it should be useful to existing and potential investors, lenders, and other creditors when making decisions about the financing of the entity and exercising rights to vote on or otherwise influence management section that affect the use of the entity's economic resources. Okay, so which means the information which the entity prepares should be of such quality that it is capable of enabling the decision-making processes of all the parties which are affected by the entity's operations, be they lenders, be they potential investors, or even the entity's management itself. So the framework sets out the information needed to assess management's stewardship and separates this from the information that users need to assess the prospect of the entity's future net cash flow. All right. So the information which is actually required by managers for their day-to-day function as stewards of the common should be clearly separate from the information which is required to be used by external parties. All right. So that is basically what the framework is saying. So the Isb framework provides the underlying rules, conventions, and definitions that underpin the preparation of all financial statements prepared under International Financial Reporting Standards. All right. So this framework ensures that standards developed within the conceptual framework provides guidance on areas where no standard exists. All right. So whatever accounting standard that was, to be considered in future, this standard was to be crafted within the limits of the interpretations of the conceptual framework. So you can see that the conceptual framework is actually the baseline. All right. So if we are creating a new standard, all right, and this standard is linked to, let's say, liabilities or some assets, all right, by virtue of being assets, it means that the definition of those assets should not deviate from the main the main definition is enshrined in the conceptual framework. So which means the conceptual framework is actually the foundation of all standards which should be made. All right. The framework aids process to improve existing standards. It also ensures financial statements contain information that is useful to users. Helps prevent creative accounting. This one, ladies and gentlemen, is a topical issue. All right. In everything we do, we should desist from creative accounting, where books are cooked, okay, or where earnings are manipulated in such a way that is meant to deceive users or to achieve a predetermined objective. The revised Isb Conceptual Framework was issued in March 2018, and the new areas included are as follows: the measurement basis to be adopted, presentation and disclosure, derecognition, okay, and while these updates have been made, the following definition of assets and liabilities, there's been some updates to this definition. It's no longer the usual definition of an asset. It has got some modifications. The definitions contain some modification, which they kindly call updates. The modification will be kindly called updates. All right, and clarification on measurement uncertainty, prudence, stewardship, substance over form. But what are the objectives of financial reporting? The objectives are to provide information that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. The decisions made by users will involve investment decisions. For example, if the users of financial statements want to invest in your company, wants to buy shares in your company, they should base their decision on what you have reported. So your financial reports should contain information that is useful. They should not contain lies. They should not contain creative figures. Okay. Financing decisions for the lenders to give you money, they need to know if you are operating, if you are healthy financially, and they can only know that through your financial reports. All right. So for them to finance you, they need to base their decision on useful information. Then voting or influencing management action. All right, this actually affects the current shareholders, for them to determine if they should go ahead with you as their steward. They need to base those decisions on the financial reports of the company. The users will be assessing the management stewardship of the entity alongside its prospects for the future, which will require the following information: economic resources of the entity. We need to know how much economic resources do we have, how much cash do we have in the bank, how much assets have we acquired so far. Claims against the entity. What obligations are we faced with? Okay, what liabilities, what debt, what is the amount of debt, the amount of gearing, etc. Changes in the entity's economic resources and claims. This usually is shown in the statement of changes in equity. Efficiency and effectiveness of management. All these are also obtained from the analysis of various financial statements, the statement of value opposite itself, the statement of cash flows. All those ones can help us to determine if the entity is operating in a healthy way. Okay, so the information that is contained in the financial statements should be useful. That's the objective of the financial reporting framework. Now, qualitative characteristics of financial information. Because if we say that the information should be useful, we need to know or to go a bit deeper and understand what we do mean actually. We are referring to high quality financial information. So what are the characteristics of this financial information? We've got two forms of characteristics. We've got fundamental qualitative characteristics, and then enhancing qualitative characteristics. Now, when you're talking of fundamental qualitative characteristics, there are two characteristics under that category. There is relevance. Information that makes a difference to decisions made by users is what is required. Okay, the information should be relevant. Relevant financial information is capable of making a difference in the decisions made by users, meaning it has predictive value. Okay, the information has got predictive value. When we are talking of predictive value, we are simply saying, based on the financial information given, we can actually try or come up with some informed forecast. Okay, we can make some informed forecast of the future of the company. Also, we have got, it should have confirmatory value. Confirmatory value simply says, based on the financial information, our previous forecast could be confirmed. Okay, let's say last year we had some going concern forecast. Okay, we made some going concern forecast, and now those forecasts could then be confirmed with the actual results which we have reported this year. So the information that is reported should have some confirmatory value. Also of paramount importance is the issue of materiality. Okay, materiality is an entity-specific aspect of relevance. Now, when we are talking of materiality, information is material if its omission or if its omission or commission. Okay, so information is material, or when its omission or commission is likely to influence the decisions of the users. Okay, so if it is of such significance, then it is considered to be material. All right, so usually financial statements do contain information. Okay, they have to contain everything that should be contained. However, sometimes by chance, certain items might be omitted. However, only those items which are material are likely to affect the relevance of the financial statements. So whatever error that is meant to obscure the financial statement or the information contained is only going to be an issue if it is material. Okay. However, there is no a one size fits all when it comes to materiality. So this is why we are saying it is an entity-specific aspect of relevance. All right. In one company, an error of let's say $50 might be an issue. However, in another company, in a company like Apple, right, they don't worry about a £50 error. Okay, they don't worry about that. All right, but they start to worry if maybe it involves something like 50,000. although they may vary if even if it is a $50 issue, but if it involves maybe a director, if their director has misappropriated a $50 note, then they might be worried. Okay, so the issue of materiality, you realize that it is material by nature. An item can be material by nature or amount. All right, so these amounts, sometimes they do matter, sometimes they don't. Okay, and oftenly an amount matters when it is now combined by the nature of the issue, where the director is somehow involved. Then there is another characteristic of faithful representation. Financial statements or financial information must faithfully represent the substance of what it represents or it intends to represent, and is therefore complete, that is, helps understand and includes descriptions and explanations, neutral, no bias, and therefore supported by the exercise of prudence and free from error. Measurement uncertainty will impact the level of faithful representation. All right, so the issue of measurement uncertainty, this one is usually prevalent on items of high managerial judgment. For example, the issue to do with fair values and so forth. Those ones might actually impact on the quality of faithful representation. However, it is being stated that the information must faithfully represent the substance of what the information represents. Okay, when we talked of the substance of a form principles in our earlier studies, this is what we were referring to. Okay, it is now an issue of reporting the substance of the transaction, not actually its legal form. Okay, now the enhancing qualitative characteristics, we have got comparability. All right, identify similarities or differences between entities and year on year. All right, this the information should be capable of evaluating or understanding or identifying where we are performing similarly to our competitors or our other sister entities and so forth. All right, so the information should be capable of comparisons either with others or in our previous accounting years and so forth. Then verifiability. This one assures the information represents the economic phenomena it represents. The information should be supported by evidence, which could be reviewed for authenticity. Then timeliness. Information is less useful the longer it takes to report. Okay, so the reports themselves should be prepared on a timeliness basis. Any delay is actually going to affect the enhancing qualitative characteristic of that information. Then understandability. Users have a reasonable knowledge of business activities. The information should ensure that the users do not struggle to understand what the accountant has reported. So it should be as simple as possible to ensure the effectiveness of the communication. So a cost constraint applies in ensuring that the information is useful, in that the benefit of obtaining the information should outweigh the cost. So in whatever effort we are going to put in terms of the preparation of financial statement, we should also be guided by the cost constraint. All right. If the preparation of the financial statements end up being so costly that the benefit of obtaining the information is now being outweighed by the cost, then we have lost our focus. All right, financial statements and the reporting entity. When you are talking of the reporting entity, this is the entity that is required to prepare financial statements. and does not necessarily have to be a legal entity. This could be a person, okay? This could be a person, all right? And that person becomes the reporting entity. Financial statements report the entity's assets, liabilities, income, expenses. For consolidated financial statements and consolidated financial statements, combined financial statements prepared for the entity as a whole, or the entity is a going concern and will continue to do so. All right. So when financial statements are being prepared, these they can be prepared for the group of companies or for a single entity, or for combined companies, joint ventures, joint operations, or for an entity as a whole, as well as they should actually be prepared on a going concern basis. Otherwise, a breakout basis would be called upon. The elements of financial statements, all right, we've got assets. These are present economic resources controlled by the entity as a result of past events. Okay? When we are talking of economic resource, we are referring to the rights that has the potential to produce economic benefits. This is what the new conceptual framework is saying. The conceptual framework 2018. 2018 conceptual framework. When we talk of liabilities, these are present obligations of the entity to transfer economic resources as a result of past events. And an obligation is defined as a duty of responsibility that an entity has no practical ability to avoid. If there is some practical ability to avoid, then that's not an obligation. We need not to recognize that liability. Ladies and gentlemen, this one is very important on discursive questions, and you are likely to meet those questions in your exam. Remember, this is a strategic level paper. Now, what is equity? Equity is the residual interest in the assets of the business less liabilities. So, residual interest in assets less liabilities. This definition has not been changed. Income, increase in assets or reduction in liabilities. Expenses, reduction in asset or increase in liability. Now, the concept of recognition and derecognition. Recognition, this is the process of including an item in the financial statements and is appropriate if it results in relevant and faithful representation. So when we are saying we are recognizing an item, we are including that item in the financial statements. Derecognition, this is the removal of all or part of an asset, loss of control or liability, no obligation. So when we have derecognized a liability, it means we are no longer having the obligation. If we are derecognizing an asset, it means we have lost control of the asset. All right. Now, when you talk of measurement, this is also part of the conceptual framework issues. The selection of a measurement basis must take into account the key characteristics of useful financial information, relevance and faithful representation, and more particularly, the characteristics of the element, the contribution to cash flows due to economic activities, and measurement uncertainty and the cost constraint. A balance is needed between giving entities the flexibility to provide relevant information that faithfully represent the entity's assets, liabilities, equity, and income, and expenses, and requiring information that is capable of both, that is comparable both from period to period and across entities. We have actually talked about this when we talked of the enhancing characteristics related to comparability. Effective communication in financial statements is also supported by considering that entity-specific information is more useful than standardized descriptions, and duplication of information in different parts of the financial statement is usually unnecessary and can make financial statements less understandable. Alright, so the issue of just using standardized descriptions, not entity-specific description, is likely to distort the whole information. So we should by all means try to tailor-made our descriptions to the circumstances of a specific entity. The first of the measurement bases discussed is historical cost. The accounting treatment of this is unchanged, but the framework now explains that the carrying amount of non-financial items held at historical cost should be adjusted over time to reflect the usage in the form of depreciation or amortization. Alternatively, the carrying amount can be adjusted to reflect that the historical cost is no longer recoverable. Financial items held at historical cost should reflect subsequent changes such as interest and payments following the principle often referred to as amortized cost. The framework also describes three measurements of current value, fair value, value in use, or fulfillment value for liabilities, and current cost. Now, fair value continues to be defined as the price in an orderly transaction between market participants. Alright, here we are led by Ifis 13. Alright, this definition I'm not happy with it. Okay, let me just try to look for this proper definition. Okay, there is a typo there. Okay, yeah, fair value continues to be defined as the price that is needed to add the price that would be received to sell an asset, okay, that would be received to sell an asset or paid to settle or to transfer a liability, okay, in an orderly transaction between market participants. Now, when we talk of value in use or fulfillment value, is defined as an entity-specific value and remains as the present value of the future cash flows that an entity expects to derive from the continuing use of an asset and its ultimate disposal. When we talk of current costs, this is the difference from fair value, and this is different from fair value, and value in use as current cost is an entry value. This looks at the value in which the entity will acquire the asset or incur the liability at the current market prices, whereas fair value and value in use are exit values, focusing on the values which will be gained from the item. Now, relevance is a key issue. The framework says that historical costs may not provide relevant information about the asset held for a long period of time and are certainly unlikely to provide relevant information about the derivatives. In both cases, it is likely that some variation of current value will be used to provide more predictive information to users. Conversely, the framework suggests that fair value may not be relevant if items are held solely for use or to collect contractual cash flows. Alongside this, the framework specifically mentions items used in a combination to generate cash flows by producing goods or services to consumers, as these items are likely to be able to be sold separately without penalizing the activities. A cost-based measure is likely to provide more relevant information as the cost is compared to the margin made on sale. So in short, historical cost, price of the transaction that gave rise to the item, whereas current value provides updated information to reflect conditions at measurement date. And current value is in three forms: the fair value, the value in use, and the current cost. Presentation and disclosure. Statement of profit or loss is the primary source of information for a company's performance, which include all income and expenses. If the income and expense arises from changes in current value, then it can be recognized through other comprehensive income. Reclassification of other comprehensive income to profit or loss, as aforementioned, is allowable if it gives more relevant information. Now, the regulatory framework. Why do we need to be regulated? Why should the accounting field be regulated? A regulatory framework for the preparation of financial statements is necessary for a number of reasons. To ensure that the needs of users of financial statements are met with at least a basic minimum of information. To ensure that all information provided in the relevant economic arena is both comparable and consistent. Given the growth in multinational companies and global investment, this arena is an interesting and increasing international one. Right? Because companies are no longer operating in one jurisdiction, they are now going global. There is actual need for some regulation in the form companies prepare their financial statements, so that if we are having a branch, say in Brazil, and we are in South Africa, okay, we need to find it more easier to compare the way these branches have been operating. Okay, so without regulation, it is actually impossible or difficult, because though the companies in the branch in Brazil would be reporting its accounts in a different way from us, so there could be some difficulties in assessment. To increase users' confidence in the financial reporting process, if we know that there's been some control, there's been some rules which were being followed, then our confidence in the use of those financial reports is increased. To regulate the behavior of companies and directors towards their investors, without some code, without some standards, it's actually impossible for us to control the stewards. Remember, directors are stewards. Also, for the government to be able to track if companies were doing it right, there is need for some form of regulation. Financial reporting standards on their own would not be sufficient to achieve these aims. In addition, there must be some legal and market-based regulation. This is why you see for listed companies, the stock exchanges also have got some listing rules, which also have some enforceable clauses when it comes to financial reporting. The national regulatory frameworks for financial reporting. There are main elements to the regulatory environment of accounting. A typical regulatory structure includes the national financial reporting standards, the national law, that is the companies law. Okay, in Zimbabwe we've got the COBI, okay, the Companies and Other Business Entities Act. Okay, we've got market regulation itself, and the stock exchange rules, as we have just discussed there. Now, accounting standards. International accounting standards were issued by the ISC from 1973 to 2000. They provide guidance as to how items should be shown in a set of financial statements, both in terms of their monetary value and other disclosures. They are a single set of high-quality, understandable, and enforceable global standards. The Isb replaced the ISC in 2001. Since then, the Isb has amended some international accounting standards and is proposed to amend others, has replaced some international accounting standards with new international financial reporting standards, and has adopted or proposed certain new IFRS on topics for which there was no previous IAS. Accounting standards were developed for two main reasons: to reduce subjectivity, inasmuch as accountants or business managers or directors are allowed to have some discretion. This has been determined to increase subjectivity, which is difficult to measure. So, with the existence of standards, the subjectivity is reduced as the managers are being forced to follow certain guidelines and certain rules enshrined in those accounting standards to achieve comparability between different organizations. So, if we know that property, plant, and equipment is to be treated this way, even if companies are different or they're operating in different jurisdictions, when they are all following international accounting standards, then it is possible to evaluate how they have accounted for the property, plant, and equipment. Financial statements may not be described as complying with IFRS unless they comply with all of the requirements of each applicable standard and each applicable interpretation. The IFRS Foundation. The IFRS Foundation is an independent organization having two main bodies. There is the trustees and the International Accounting Standards Board, the ISB, as well as the IFRS Advisory Council and the IFRS Interpretations Committee. The IFRS is governed by the board of 22 trustees, the IFRS Foundation. Okay, this is the foundation. Is governed by a board of 22 trustees. The IFRS Foundation trustees are responsible for the governance and fundraising and publish an annual report on the ISB's activities. The trustees also review annually the strategy of the ISB and its effectiveness. The trustees approve the annual budget of the ISB. The trustees also raise the funds necessary to support the IFRS Foundation. The trustees appoint the members of the ISB, IFRS Interpretations Committee, and IFRS Advisory Council. The International Accounting Standards Board. The International Accounting Standards Board is an independent, privately funded accounting standard center based in London, UK. There are 14 board members, each with one vote. The ISB is committed to developing in the public interest a single set of high-quality, understandable, and enforceable global accounting standards that require transparent and comparable information in general purpose financial statements. All right. When you talk of general purpose financial statements, these are financial statements which are meant for external users. All right, which have been prepared for users other than those internal to the entity. So they are called general purpose. All right, but it doesn't mean that the word general is undermining the issue of high quality financial statements. Do not be confused by that term. Okay, it simply means that they are the accounts which are no longer management accounts or internal, but they are for the general public. They are for external users. In addition, the International Accounting Standards Board cooperates with the National Accounting Standard Setters to achieve convergence in accounting standards around the world. So, the issue of convergence, okay, it is being said here that the ISB itself, okay, although they are producing global accounting standards, they also have to cooperate with the national accounting standard status to to achieve what is called convergence. All right, so it's actually an issue of marketing the idea to the local, to those in the, to the accounting standard setters at national jurisdictions, okay, not at global. For example, in a particular country, the ISB might be interested in negotiating with those guys to arrive or to assist them in coming up, in crafting the accounting standards so that they conform to the global standards. So the following picture gives a clear, this diagram gives a clear picture of what is happening, okay?